quick refresher for those of you that are new to the channel or those of you that just have a bad memory. BRRRR stands for buy, reno, rent, refinance, and repeat. So again, I already did a 5-part series on these 4 parts of the BRRRR investing strategy, but I'm going to use this example right here. This is another property that I've BRRRRed. I'm just going to use this as an example of the repeat. What did this property look like in particular? Well, they were asking $145 for the property, but we knew that that was going to be too much because our ARV for a property like it, once it was fixed up to the standards we were planning to do, was only going to be $200,000. We knew that our ARV on this property was going to be $200,000. So how do you figure out what your ARV is? That's a great question. It's honestly something that comes along with skill, with becoming an expert in your market. You need to pull the comps, have your realtor pull comps of houses that sold in the last 6 months or last 2 years, depending on how hot your market is, and try to find the closest thing to apples to apples. But so in this case, we knew the area. We knew $200,000 was a pretty safe ARV simply because everything else on that street was selling for $240. Now this was definitely the smallest house on the block. It was definitely in the worst shape. So we knew that we were probably going to come in at the low range of what the average house on that block sells for. So we knew that by planning for $200,000 as our ARV, we'd probably be pretty safe. What we ended up doing instead was we negotiated with them. And now this negotiation took, I think it was almost 2 months. Jeff Weibel, remind us in the comment section how long this negotiation took. But I think it was about 2 months it took us to negotiate on this, but we eventually agreed on a price of $122,000. You can see right there, we're about 60% of that ARV. So far, we're looking pretty good. We bought for 60 cents on the dollar. Now, what were our renovations going to cost us? So our holding and closing costs plus our renovation costs ended up adding up to $28,524.28. So actually, being a little bit more accurate, this was actually 61%. So we're at 75% of our ARV. The way you get that higher ARV based off of so little renovations is through strategic renovations. I did a whole video just documenting what I approach for strategic renovations. It often includes laundry and dishwashers, as well as paint, as well as retrofitted kitchens. Those are the best ways to do huge value adds in my opinion, while keeping the costs very low and very reasonable. So it's now time, the place is looking great, it's time to find some great renters so that we can get a cash flowing rental property. It was kind of a quirky property, a family home that had a granny suite and then a large detached heated garage. So long story short, we rented it out to one person, but they kind of rented out all 3 parts of the property in different aspects. And so currently what we're getting for rents are $900 for the main floor, $700 for the basement, plus $200 for the garage. So we're essentially at $1,800 a month in gross rents. So you can see again, we're getting really close to that 1% rule that I talk about all the time on my channel. And reminder, the 1% rule is you want your gross rents to equal 1% of the value of the property. So in this case, ideally, if we're going for that $200,000 ARV, we'd have $2,000 in gross rents. Now, I'm not even following my own rule here. The thing is, there's always a little bit of leeway with the 1% rule. It's just a rule of thumb, and like any rule of thumb, you can't just use it purely by itself in isolation. You have to look at all the situational facts. So in this case, you know, part of the situation was I'm actually renting it out to a longtime tenant of mine. So I know I'm going to have less turnover. I know I'm going to have no collection problems. And I know that they're going to be pretty easy on the property because he's been a tenant of mine for years now. So that's kind of what gives me comfort in this case. So once you have it rented out, it's now time to go back to the bank and get it refinanced. So you're going to have to get an appraiser out. And so there's all sorts of different, very specific mortgage products and solutions that you could use to get into this sort of BRRRRing strategy. And it's going to be different in the US, it's going to be different in Canada, and it's even going to be different depending on your specific jurisdiction. So we're not going to get caught up in the real nitty-gritty details of that. If you're from Canada and you're curious about how I approach these, if you dive into that 5-part series, again, just hit that I, where I go really in depth, and in the comment sections I go even further in depth, breaking out everything for you guys. So then it's time to refinance. The appraisal came in where we expected at $200,000. What happens with that $200,000? Well, in Canada, when you have an investment property, you can only get an 80% loan to value. And so in that case, that means your mortgage is only going to be 80% of the reappraised value. This equals a new mortgage of $160,000. We take that $160,000 and we pay off the cost of the property plus the renovations. So in this case, this $160,000 is going to go and pay off this and that. So we have our $160,000 here, subtract our cost of purchasing the property, subtract our holding, closing, and renovation costs, and you can see that we end up with $9,475.72 and more money than we started with. This is what's so powerful about that BRRRR investing strategy. So let that sink in. We actually now have $9,000, almost $10,000 in more cash than what we started with. So what does this actually all mean though? If you're new to real estate investing, this could seem kind of all confusing. But so what this means is we now own a property worth $200,000 that's been confirmed by the bank through the refinance, and we now have a $160,000 mortgage. We actually have $40,000 in equity plus our $9,475.72 in cash. That's how, in a period of under 6 months, through BRRRRing a rental property in London, Ontario, I was able to create $49,475 in new net worth for myself. But I get it. Some people are still going to hate on this, and they're going to say things like, wait, that barely even counts, man. You know, only 10,000 of it's cash. The other's just equity you can't touch. I mean, okay, if you want to hate on the fact that you can't get access to all your money right away. But remember, this is tax-free. This wasn't capital gains like flippers have to pay. This was straight up tax-free, guys. So I would argue it's actually more favorable than actually what a flipper would make on a deal. Secondly, you're still left, if you've done this right, you're still left with a cash flowing property that's just in your portfolio now for as long as you want. But you also need to remember that because this property is cash flowing but has a mortgage on, you're also paying down the debt on the property. So in this case, I think we're paying down about $450 in mortgage principal per month on top of what we're doing already through getting access to that $10,000 in cash, creating that $40,000 in equity. I mean, this is what gets me so excited about BRRRR investing. This to me is why this is one of the most powerful investing strategies that you can implement, particularly as a new or younger real estate investor. Because when you're investing in real estate, your capital is so important. It's probably the most limited thing you have, and you're going to be coming from a mindset of scarcity. So the idea of hard money lending, the idea of borrowing outside of traditional lenders, it's going to be probably scary for you. And so this to me is one of the easiest ways to get into real estate investing and recycle your money in a short period of time while still getting a good investment. Whew, gets hot. So again, quick summary. We bought this for $122,000, spent $28,000 on renovations, holding and closing costs. We knew the ARV or expected it to come in at $200,000. We got it refinanced at the bank after we rented it out, and we were able to get a new $160,000 mortgage. Because of that mortgage, we were able to pay off the $122,000 purchase price as well as pay off the reno, holding, and closing costs, which means we ended up with positive $9,475 in our pocket. Plus, we didn't incur any taxes because this wasn't a capital gains eligible sale. This was just a refinance where we're accessing that new equity we created. And so in this case, once the dust settles on the refinance, we now have a $200,000 property we own. We owe $160,000 on it, so we have $40,000 in equity plus the $9,000 in cash, which gets us to that almost $50,000. And again, I did this in under 6 months, but I was distracted at the time. I was doing like 4 other deals as well. I was doing these YouTube videos, spending way too much time trying to make these YouTube videos. And so that's kind of why it took me longer. If this was the only thing you were focusing on, you could easily crank this out in 90, 120 days. And that's what a lot of real estate investors I know. A lot of these guys are doing it in 8 weeks. And that's what I showed you on my previous playlist where I documented in depth. And so I know you're gonna have tons of questions about the exact strategies behind this. But remember, this is really just meant to be a high-level summary. Jump over to that other playlist to learn all the specific tactics and details about how I implement the BRRRR investing strategy. Again, that's just how I do it though, but each area is going to be different. What sort of markets is this favorable in? Well, in general, you want markets that are relatively balanced. So you want a market where, you know, you can still find a cash flowing rental property. You want a market where the 1% rule can still apply. You want a market that's not spiraling downwards. As long as the market's flat or moving up, this BRRRR investment strategy is a great approach to making money in real estate. And I can't even focus because of you piece of shit. Okay, that's the BRRRR investment strategy. I hope you guys enjoyed this video. I tried to keep it as concise as possible. Remember, you can always check out that other playlist. But in the meantime, if you got value from this video, could you do me a huge favor? I appreciate all the new subscribers I've got. I love the fact that you guys are hitting that like button, you're leaving me comment, but know what would be really special? If you would share this video. Share this video on your social media. So if you could click that share button and share this on Facebook or on Twitter, it would mean the world to me, guys, honestly, or share it on Reddit, that would be fantastic too. And if it spikes, I'll do something. I don't, tell me in the comments what I should do if you guys just like share this video like crazy and it spikes on me. Maybe more books, maybe a one-on-one phone call. Yeah, just let me know what we should do and we'll do some sort of giveaway in the future. Anyways, thanks for taking the time to watch this video, guys. I really appreciate it. YouTube wants you to check out the videos down below this video right now, so check those out. I think they're probably pretty cool. If you haven't already subscribed, smash that subscribe button. Thanks.